Hi, everybody, and welcome to Multifamily Meetups. It's been almost like twice a month session, at least now that we've been doing this. It's been an interesting year with COVID, but we're just about done, thankfully, with this year. And I think we can all kind of see the light at the end of the tunnel. We're getting there. Vaccines are going to be starting, I guess, hopefully tomorrow they're getting the approval. A few doctors that I've been talking to already have a sign-up sheet in their office of when they're getting their shots, and that's all happening like before the end of the year. So great news for that. The last session that we did was basically kind of like a wrap up of like what happened to the real estate market this year and a forecast as to what was going to happen for 2021. And we were all really surprised that in LA and overall in California, that prices actually have increased this year. In LA, depending on the neighborhood, but average over 10%, prices have gone up. For the state, over 8%. So that was pretty shocking. The amount of real estate that actually sold, the volume was just slightly under what it was for last year. And we expect next year for that to be an increase. So the big variable, right, and everything for next year that we're all kind of waiting on to see what happens is COVID. And in LA, a lot of our market is really dependent on the film industry. And so far, the film industry has been allowed to be open and continue to work. Restaurants have been shut down for outside dining. And surprisingly, I was, talking to friends on the East Coast who have restaurants, and they're still allowed indoor dining for quite a few cities. So here, unfortunately, in LA, indoor and outdoor dining is shut up for the next 3 weeks. I was on a call with one of the LA controllers and a couple of people from LA City and West Hollywood, the Restaurant Association yesterday, and they believe that in 3 weeks that restaurants will be allowed to open, that there is going to be a stay on keeping restaurants closed for the next 3 weeks, but that there's some legal issues with the data that they proved to shut down restaurants, that it's not really holding up, and that they most likely will be able to open. So that's, would be a good sign for our economy, moving forward, and for all the businesses. Real estate this year, we've been really lucky that, we've been able to stay steady with prices and volume, and a lot of great stuff has been going on. And maybe Will, if you want to just touch briefly on how it's affect multifamily, and then let's get right into our main speaker with taxes and tax saving. It's that time of year, right? What can you do before the end of the year to maximize your profits and get ready for next year? So anything you want to say, because this is our last meetup for the year for our multifamily group, and then we'll be back in January again. So anything you want to say to kind of wrap up or summarize anything on the multifamily side?
Absolutely. Hi, everybody. Good to see you. It's been, as Anthony said, quite a year on a lot of fronts. For those of you who have been regulars here on our multifamily meetup, you know that just keeping up with all the different legislation on every level has just been dizzying, right? I mean, between the local, the county, the state, and the federal, it seems like, no one's talking to each other, but they all feel like the answer has been eviction moratoriums. That's been their way of kind of dealing with stuff. But of course, everybody's saying different things about that. So we've tried our best to keep you guys informed of all the different laws and regulations that have been going on. If you have any questions regarding any of those things, we're happy to discuss them with you, and we'll put our information in the chat so everybody has it. We get calls every day. I get calls every day from people who are primarily looking for property management, because the number of different rule changes have been dizzying. Just to give you another update of what's been going on, kind of and so far this is all proposals, nothing's in writing so far, but there is talk on the state level to extend the current statewide eviction moratorium, which currently ends on January 31st, 2021, to extend that for another year. So there is talk about that. It would be modeled, at least from what I'm seeing, on an extension of what they say is the I can't remember the term of it. There's a beautiful term of art that they put it. So there was one section which was from March through August 31st, where basically tenants, if they did not pay their rent, basically could not be evicted for that reason. And even if they paid zero of that money. Starting from September 1st to January 31st, you need to pay at least 25% of your rent. Or you could be evicted on that. Anything else that you didn't pay on top of that could then be collected from, the tenant would still owe that money, but the landlord could then potentially get it through small claims court, but could not file a unlawful detainer except for that 25%. So there's talk about extending that for another year. Whether or not that's going to pass, these are all questions. It's way above my pay grade, but it's just something to be aware of. There is talk about extending the federal eviction moratorium, and both the Trump administration and, as it appears, the upcoming Biden administration has talked about extending that moratorium as well. So
and if that's extended, we'll know through the stimulus package, right? It'll all be a part of that that plan that comes out.
Well,
Correct?
no, that's actually slightly separate. If there's a stimulus package, one potentially positive thing that they're discussing is that there is in the last version of the stimulus package, there's $25 billion for rental assistance. So that could be hopefully helpful to everybody. I think there is finally a realization amongst politicians that landlords can only take it on the nose for so long, right? It's kind of, considering that, what is it, 70% of apartments are owned by mom and pop landlords. And I think there's a realization, and there hasn't been any secession of, say, property tax, or there hasn't been secession of any expenses utilities or any other things. So because of that, there's a realization that, it's been unfair to the landlords to have them shoulder the burden of this. So there is hope that there will be some, additional funds coming through the stimulus if it passes, because that's a big if right now, and it's not clear. What has this done for the multifamily market? Well, I would say that generally speaking, the multifamily market has been pretty slow, particularly for turnkey properties, those properties that are already redone and remodeled. Those things have just been sitting lately, because nobody's pretty much buying a 4.5, 5 cap in California on a turnkey property at this point. I'm seeing very, very few of those sales go through. People are still looking for value add. I'm currently in escrow with clients on a 4-plex in Virgil Village. It's a value add. There were multiple offers on that. As some of you know, I sold a 30 unit earlier this year, heavy value add in Boyle Heights. That got multiple offers. We closed that above asking. So value add properties are still definitely, because people are looking to the future, right? The people are looking past COVID and seeing what that can do. So those things are still happening, and people are still snapping those up, and there are still deals to be made on that front. So once again, happy to discuss that with anyone. Now, there were a few questions from on the meetup page, and I wanted to go through some of those questions. Will be more for Tony, and I'll let Tony answer them as they come through. But some of them are specifically multifamily, so I thought I'd go through all of them. So Eggy wrote asking about the market in 2021 and when it's a good time to buy. Well, obviously, once again, it depends on what you're looking to buy, but I think we all know that interest rates are a historic low, and that includes for commercial loans as well. So commercial lenders are being a little bit more picky about how much they'll lend out. They definitely become much more conservative. You may have to put more down. For those of you who have bought commercial properties before, 5 units and more, that typically means that the bank is going to look at the property itself and then do an analysis of the property and then tell you how much of a down payment it requires. They may have required a little bit less pre-COVID. Now they may require more. It might be 30, 35, 40%. So those are just things that to consider. But there are definitely still deals to be had. There are people who want to get out of California. And so because of that, there are opportunities to pick up things. So
I mean,
definitely I would be on the lookout.
I mean, I think in my opinion right now is a great time to buy. Now, December, January, especially now that we're on a stricter lockdown, you are still able to see real estate. You just have to make an appointment, and there's limited amount of people that can be in a property. So there's going to be less people out there looking for properties right now because they're just not comfortable going out. So if you are comfortable to go out and see a home and do it safely, I think the next 2 months would be a great time to look because you have less competition. Like Will was saying, this year, so many properties we've had have had multiple offers. I think there will be less multiple offers right now. I wouldn't say now is the best time to list a property. I would probably wait 2 months. But if you're looking to buy, I think this is a great window. Rates are at all-time lows. They're going to go up at some point, hopefully, not for a while, but there is a window right now in the next couple months that I'm really pushing some of my clients to take advantage of.
I will say I do have a triplex that's going to be coming to market here pretty soon. It is a fixer. It is going to be in Los Feliz. It'll be the front building is 2 3-bedroom, 2 baths. And in the back is a 1-bedroom, 1 bath. One of the 3-bedroom, 2 baths is being delivered vacant. That would technically fall under residential because it's a 1 to 4 unit property. So if people are interested, please let me know. Another question Sean just brought up is the proposed extension on both residential and commercial. At this point, the one that I read about that was statewide, that one's only for residential. They haven't talked about commercial yet. The commercial eviction moratorium was a county moratorium. And the county has not said what they're planning to do other than to close restaurants. We do know that. But other than that, we outdoor dining anyways. But they haven't said anything about eviction moratorium. Another question, Nick asked about financing. Obviously, I mentioned financing earlier, that getting financing now. On the 1 to 4 unit properties is still kind of your standard residential qualifications. It's more of a debt to income thing. But on the commercial properties, lenders are definitely asking for, being a little bit more conservative. So you should definitely shop around for that. But lenders, are still giving great rates. I mean, just incredible rates, sometimes in the 2s, but definitely in the 3s and 4s is no problem. How difficult is it to qualify as a real estate professional for tax purposes? That I will leave to Tony. Another question, withdrawing from your IRA at 59.5 to use as a down payment on a home purchase. Once again, that's going to be a tax question. I'm going to leave that to Tony.
You writing this down, Tony?
Sandra,
read these back to me when I'm done with my.
Of course.
Right? Yeah. Okay.
Of course. Sandra and Caparo both ask about tax savings, tax planning, 1031 exchanges. So I've gotten a lot of questions about 1031 exchanges lately, as many of you know. 1031 is a great way to defer capital gains on a major gain in an investment property. Now, a lot of people have said, well, Joe Biden proposed eliminating the 1031 exchange in his presidential platform. And that's true. That is something that he did propose in his presidential platform. Will that be passed? That's a totally different question, because that would obviously be a major change to the tax code. So, but it's something that we should all be aware of and be watching out for, and be considering as the new Congress comes in, and if it does become presented, it's something that we all of us who have interests in real estate should be aware of. Let's see. Somebody wrote, EC wrote about fourplexes and condos. Doesn't say what about fourplexes and condos, but there are plenty of fourplexes and condos for sale. Somebody wrote about asking.
Oh, is it Ellen? And if you're on, if it's you, maybe clarify your question, and we can be happy to answer it. Yeah, sorry.
Let's see. So Sean asked again, do we know when the LA County is due to end at this point? I'm assuming, Sean, you're talking about the eviction moratoriums for both commercial and residential. At this point, the state's eviction moratorium is superseding like any local jurisdiction. So everybody is kind of leaning towards January 31st as the current end date, but obviously we don't know with this new surge in COVID cases. Yeah, I don't see any other major questions that are being asked. So I think we will move it over to Tony. And for those of you who don't know, Tony is a regular guest and friend of ours. He works for Robert Hall and Associates. He is a CPA and tax consultant over there. Some of you may have heard of him before, either here or in other groups. He is very, very well versed, particularly in real estate taxation and ways to save on your taxes. So Tony, I'll let you take it from here.
Beautiful. Thanks again for including me. I always love speaking for the collective. It's always good to see familiar and friendly faces. Welcome everyone. I know that we've got quite a few people logged in and also watching from Facebook, it looks like. So welcome to tonight's webinar. I'm glad that we're able to at least keep connecting with each other on a digital platform. I'm used to speaking to people in person, shaking hands and seeing people's nice smiles and sharing, in-person communication. But ever since February, we've all been pretty much in the lockdown in one way, shape, or form, right? And it doesn't seem like 2020 is ever going to end, but we're all enduring together. We'll get through this together. And I think that if we can mainly focus on educating ourselves during this very unique time in our lives, number two, taking advantage of every single opportunity that comes our way, and more importantly, capitalizing on those opportunities while keeping in mind that we are approaching the end of this calendar year. So tax season is right around the corner, keeping that in the back of your mind. I think that as we enter into 2021 and the economy does start to turn around, whatever direction that may be, that we really are open for all of the unique opportunities that will be coming our way. So at the end of every year, we have a final exam. I call it a final exam. It's our tax filing. So obviously, as we approach the end of 2020, we're going to be thinking about 2020's tax filing season. What are we going to have to settle up with as far as IRS tax and state taxes concerned? So I'm bringing you the wonderful topic of year-end planning tonight, some major moves before the end of the calendar year to hopefully result in some major tax savings benefits. My name's Tony Watson. I work for Robert Hall and Associates, like Will had mentioned. I've done a number of seminars with the collective, with Will. I know that, Will, you've been a client of Robert Hall's for quite a few years now. I've been working with Bob Hall and his team for going on, actually more than that, 16, going on 17 years now. I focus on individual and business tax preparation, and I also have the privilege of representing RHA as far as being their keynote speaker. So I speak at over 100 events on average per year, mostly in person normally, but obviously most of them are webinars nowadays. So once again, I feel very privileged to even be able to communicate with people on a digital platform, especially during these uncertain times. So once again, thanks again for including us tonight. So why is it important to approach the end of the year with a plan? Why is it important to take a look back at the past 11 to 12 months and come up with a calculated position to help you reduce liability, not only audit risk liability, but actual income tax liability, and potentially put yourself in a position to pay overall less tax to Uncle Sam, the state of California, and in other avenues of business as well, not only on the state and the federal side, but also maybe even on the city side. So as we approach the end of the year, we're going to want to sit down and map out a strategy to pay what I consider to be an obligation in tax to Uncle Sam and the state, and not a penny more than that obligated amount. And so right now, a lot of the consultations that we're having with our clients, once again, not in person at the moment, but by phone and FaceTime and Skype and Zoom, a lot of the consultations that we're having are really not to look forward into 2021, so to speak, because there's still a lot of uncertainty about where the tax code will land in 2021, but more importantly, to take a look at 2020 and figure out, hey, where was our business this year? Even with the pandemic, I find that a lot of my real estate clients have actually done pretty well in 2020, especially if they're making a majority of their real estate income through commission income and selling or acquiring or even helping clients exchange properties. On the rental aspect side of things, sure, there is the results of the pandemic have caused tenants to not pay rent. They've lost their jobs. They haven't been going to work. So there's a little bit of a shift there, but that first round stimulus really helped and assisted a lot of people. And I think the second round stimulus is not too far off, but at the moment, nothing's passed with that second stimulus. But why is it important for everyone, whether you're the rental property owner or the self-employed business owner, why is it important for you to sit down with a tax advisor and map out this strategy? Well, I've asked a number of my clients, I've asked my coworkers, I've asked friends and family members throughout the year why they think year-end planning would be important to them. And I've come up with 3 answers after dialing in all of their answers. Number 1, it would be to avoid any unnecessary penalties and interest. Number 2 would be to position themselves for greater tax benefit in one way, shape, or form, either capturing deductions before the end of the year, helping reduce overall tax liability, or even setting themselves up to apply for financing with lower interest rates to make the qualification process a little bit easier just by getting ahead of the curve, dialing in the year-to-date income and approaching lenders and saying, hey, this is where I'm at, how much could I possibly qualify for? So just positioning themselves in different ways. And the most common answer tends to be peace of mind. People want to know ahead of schedule what their obligation in federal and state income tax is. I always joke around with people. I mean, I don't think we all want to know our future. That could be kind of dark in some cases. But if we can tell what the results of our tax filings are before we even file our tax return, well, shoot, that puts us in a pretty powerful position, right? If I can sit down with a client and map out what is called their effective tax rate, essentially what you actually end up paying in tax before the tax filing season even is here, and let's call your effective tax rate 24%, well, I can send my client back out into the wild. I don't call it the real world anymore. I call it the wild these days. I can send them back out into the wild to reinvest money back into their own investments, whether it be a small business or a rental property. And essentially, knowing this effective tax rate can tell you every dollar you spend before the end of the year is potentially going to return you 24 cents on the dollar in tax savings. So you have to think not of tax planning as tax reduction or paying overall less tax. You have to reprogram your thought and your approach to year-end planning and think of it more as helping you or assisting you in retaining wealth that you built for yourself over the course of 2020. So don't think of it as tax saving, think of it as retention of wealth planning. Because obviously we're not in the business to pay tax, right? We're not in the business of just to break even. We're in the business of building wealth for ourselves so we can be more philanthropic, so we can support family members and coworkers and friends and do great things for this world. So program your mind to think, how can I better retain all of this hard-earned money that I've built for myself and my family over the past 12 months? So this year-end consultation, I mean, most people will call it a consultation. I actually call it a year-end W-4 review. That's more of a technical term in the tax industry. So when I sit down with clients, or when any of our associates here at Robert Hall sit down with clients for year-end planning, whether you're an employee or a self-employed individual, the importance of year-end planning is one and the same, but the approach is much different. See, if you're an employee, most likely you've already prepaid a majority of your tax. You filled out a W-4 with your employer to withhold federal and state income tax, and then you have your year-to-date taxable income. You might have put money into retirement. You might have, avoided retirement this year, kept most of your cash, in your bank account. Whether you're the deferral or the person who wants to keep most of their cash liquid, the W-4 review for a W-2 wage earner is a little bit different. The approach is different because you've already prepaid all of that tax. With a self-employed individual or a real estate investor, the approach is much different. We actually need to dial in accurate figures as far as gross revenue is concerned, whether it be gross rents or gross commission income, and then have a really good idea or finely tuned number as far as year-to-date expenses are concerned. And if we can get ahead of the schedule, if we can figure out that your gross revenue was, I don't know, call it $100,000, and you've spent $40,000 this year in deductible expenses, you have $60,000 that you have to settle up with Uncle Sam on in the state of California. Well, I mean, shoot, if it's the beginning of December, we still have 3 weeks before the end of the calendar year to go out and reinvest more of that profit back into our business. And the government allows you in most cases to dollar for dollar deduct reinvestment back into your business. Meaning if you spend another $20,000 on marketing and advertising, shoot, you don't pay tax on 60K anymore, you pay tax on 40,000. And so we're seeing a lot of individuals, especially during this weird time in our lives, take a lot of their profit and their earnings, their savings over the past several years, and really capitalize on some of these ways to market and advertise their business. So once the economy does open fully back up, California might take a little bit longer because of the new shutdown requirements, but once the economy does return to whatever the new normal will be, they're going to hit the ground running. So most business owners have really tried to capitalize, at least most of my clients. I can't speak for everybody in the US, but most of my business clients have really taken a step back and tried to figure out ways to capitalize on what's going on in the world, not taking advantage of people, but taking advantage of certain tax positions to overall pay less income tax when they get ready to file. Now, some of you might be thinking, well, I've made a certain amount this year, maybe it's more, maybe it's less, maybe we're right on track to making what we made in 2019. So Tony, how much should I be looking to prepay before the end of the year to avoid penalties and interest? Because that was a big concern of people who I was asking about, the importance of year-end planning. And the government has finely tuned this calculation, over the 17 years that I've been working as a tax advisor. This probably goes back way before I started as a tax preparer, but the government finely tunes this calculation and states that if you want to fully avoid paying penalties and interest, you have to cover one of two numbers by January 15th, not December 31st, January 15th, which is the end of our fourth quarter, right? So the tax year is divided into 4 quarters. December 31st is truly the end of our calendar year. So when we talk about buying computer equipment, buying desks and chairs, things that are tax deductions for us, December 31st is the deadline for those expenses. But to prepay your tax, the government actually gives you a buffer of 15 days into the new year to cover one of these two numbers. So it's either 90% of the current year liability, so whatever your 2020 liability is going to be, you either have to cover 90% of it by January 15th or 110% of 2019's liability, whichever is greater. So you can imagine if 2019, you were absolutely cranking with your business, your profit was through the roof, well, 110% of that year's liability might be significantly overpaying the liability that you have in a much slower year like 2020. So obviously, you'll definitely want to sit down with a tax advisor and see if, hey, maybe you might not even need to make that fourth quarter payment. Because if income is less this year, why would you pay 110% of the higher year revenue if your income is only 50, 60, 70% of what it was the year before? Let's flip that scenario. Let's say that 2020, you've really been able to hone in on some unique opportunities. Your revenue is through the roof, and it's maybe double what it was in 2019. A very unique situation, right? Well, at that point, covering 110% of the previous year's liability would not ensure that you were off scot-free essentially on penalties and interest. Because if your income doubled this year, you got to play by the 90% rule, where you got to at least pay 90% of this year's liability by January 15th. These are specifically calculated numbers that, you could try to calculate yourself. I wouldn't suggest that, but that you need to sit down with your tax advisor and map out with them. You don't only pay a tax advisor to file a tax return. You also pay us for consulting. That's a part of that preparation fee. And so you should have conversations. If you're self-employed or a rental property investor, you should be having conversations with your tax preparer more than twice a year. Obviously, to file the tax return, to do year-end planning, that's 2. And then throughout the year, maybe even doing mid-year W-4 reviews throughout the year. So maybe 3, 4, 5 conversations throughout the year to be had with your tax advisor. That's what we're here for. We're not just people who work during tax season and then take off the rest of the 8 months of the year. We're working year round to make sure that we bring as much tax advice and tax strategizing to our clients as much and as efficiently as we possibly can. This year's been a little bit of a challenge just because we have to communicate by phone and FaceTime and Zoom, but we've been able to do that. And what this year has taught us, at least myself as a tax advisor, is that I've always been more available than ever. We've picked up a lot of new clients because we have actually adopted the new way of doing business, this digital platform. And we scrambled very quickly during February and March of tax season to be able to continue connecting with our clients in the most efficient way possible. So understand that if you want to truly avoid overpaying Uncle Sam, you got to sit down and do a W-4 review. Whether you're an employee or a self-employed business owner, you got to put a plan in place. Remember that failing to plan is ultimately planning to fail. That phrase goes hand in hand with what we do in the tax industry more than just a couple ways. If you fail to plan, you will not like the results. You're basically planning to fail at that point. So keep that in mind. And as we approach the end of the year, you're going to be seeing other opportunities. You're going to be seeing, hey, I have all this cash sitting in my bank account. What kind of tax liability am I going to be looking at? And should I reinvest some of that back into marketing or advertising for my business? Should I go and upgrade a computer or buy a new desk? I mean, a lot of us were basically pushed out of the office this year and forced to work from home. I feel very privileged and very lucky to have an office where I can come and work from that gets cleaned every day. I mean, not everybody has that. So I feel very fortunate in my world to have essentially 2 locations to work from, home and the office. But at home, I had to buy a desk, I had to buy a chair because I wasn't used to really working from home as much. And so a lot of these expenses for business owners, they're going to be great dollar for dollar adjustments to their taxable income in 2020. And the reason why I like supplies and equipment so much is, number one, it has a very low risk for audit. I mean, think about this. How many people do you know in your world, in your financial world, in your business world, who can do what they do without a cell phone? Who can do business without a computer, who can do business without a printer or a desk or a chair or a filing cabinet? I mean, these are the most common deductions under Internal Revenue Code. And so it has a very, very low risk for audit. The government knows that you need these things to do business. And number 2, you have the ability to either take these deductions fully in 1 year or spread these tangible assets like a computer or a cell phone over the lifespan of this asset. Now, a computer and a phone equipment has 7-year depreciation lifespans. Office furniture like desks, chairs, filing cabinets, they can be depreciated over 5 years. So if you are that person who's made a little bit less revenue this year, you already have enough expenses to cover your overall profit. And let's say you're on track to not paying any tax. Why would you try to force a $2,000 MacBook laptop expense all in 1 year? Wouldn't you want to spread that over the lifespan of the asset and actually use it in a year where you actually had more profit? Of course. So you have options of how to deduct equipment, how to deduct furniture. And so number 1, very low risk for audit. Number 2, you have options of how to write this expense off. That happens to be one of my favorite overall write-offs. I know I'm a nerd, but I'm a tax preparer. I got to like some of these things, right? Car and truck expenses, a very unique overall write-off. For most of you, you're thinking, well, I either lease or buy a car and they're going to be deducted in specific ways. And that's absolutely the truth. A lease payment on a car is a much lower, more consistent write-off. Purchasing a vehicle can be a much larger upfront deduction. But depending on your financial situation, how much your profit is this year, where your car situation is at. First of all, I'm not going to send you out to buy a new car if you aren't already looking at purchasing or leasing a new car. I'm not going to send my clients out to spend money just for a tax write-off. These just happen to be conversations that are a part of our year-end planning consultations. Purchasing may give you a major benefit. And depending on the weight class of the vehicle, if the vehicle is under 6,000 pounds, I know that's a weird number, but IRC, Internal Revenue Code, is a weird code anyway. But if the vehicle is under 6,000 pounds, the upfront depreciation write-off that you potentially could qualify for in the first year is $18,000 because it weighs under 6,000 pounds. If you go out and you buy a vehicle solely for business use and it weighs over 6,000 pounds, like a Chevy Tahoe, a Cadillac Escalade, a Silverado, or one of the Tesla trucks or the Tesla Model X, which is the big SUV with the extended range battery. All of those vehicles, gross weight is over 6,000 pounds. And if the vehicle weighs that much, it doesn't qualify for an $18,000 depreciation write-off. It qualifies for something that has only been around since 2018 called 100% bonus depreciation. And that could potentially, not everybody will qualify for this, but it potentially could qualify that car deduction at 100% accelerated write-off benefit, meaning that if you make 100,000, you spend 100,000 on a 6,000 pound vehicle, you could potentially pay 0 federal income tax. This is a great benefit on your federal tax return, but it makes no difference on your state return. California has not adopted this 100% bonus depreciation write-off, so understand that IRS will allow it, California will not. Great conversation for you to have with a tax advisor. I don't have enough time to go through all of the hundreds of scenarios where it might be a deduction for one person and not the other. I would highly suggest that you take Robert Hall & Associates up on our free consultation offer, which I'll remind you about at the tail end of my presentation tonight. Great overall year-end deduction, because at this point, in order to take that bonus depreciation write-off, you don't actually have to buy the car outright. You can put $5,000 or $10,000 down, borrow money to finance the rest, and it still doesn't negate the fact that you purchased the car. You just use somebody else's money to buy it, right? So the government will still allow for that accelerated bonus depreciation as a write-off. So great, great year-end moves, major moves for major tax savings benefit. Okay, so keep that all in mind. Legal and professional fees going to be dollar for dollar adjustments to your self-employed income or rental property income. So there are still sections on your Schedule E rental investment forms and your Schedule C small business forms where you can plug in legal and professional fees as dollar for dollar write-offs. Great overall deduction. Now getting to one of my favorite topics, property deductions. And in order to dive further into the property deduction side of things, we need to determine whether or not a property is a primary residence or a rental property. Now, also under the primary residence topic, we have to include second homes, not rental investments, but homes that you use for personal use that is a second home for you. I believe that the IRS says that it has to be over 50 miles away from your primary residence in order for it to qualify as a second home, but it's a home that you don't rent out, maybe a vacation home or a second residence somewhere in the mountains to get away from the city. Sounds amazing right now, right? So obviously primary and second homes, they have to play by a different set of rules as opposed to a business such as a rental investment, okay? When you turn a property into a rental investment, you start to collect revenue on it. You have business expenses at that point. Whether you like it or not, the government sees you as a business owner. And that's a good thing. Don't think that this is a bad thing. This is a good thing because businesses receive all of the tax benefit, both under the new tax bill and under the old tax bill. The federal government knows that if you own a business, the likelihood of you generating enough revenue to hire contractors, to hire employees, to pay for extra services, you are actually creating jobs in the US economy or for the US economy. So naturally, just under old and new Internal Revenue Code as of 2018, naturally, the business owner is going to get a majority, if not 98 to 99% of the overall tax breaks. Whereas a primary residence and a second home, those are personal assets. So you're limited as to what you can deduct on a primary home that you live in and a second home, right? And not everybody is not wealthy enough, but financially liquid enough to have a second home, right? So primary and second homes, they kind of get grouped into one bucket. On a primary residence and a second home, currently, if either of those homes were purchased after the beginning of 2018, to be specific, December 15th of 2017 or later, meaning that you bought it after December 15th, 2017, you are only allowed the interest write-off on the first $750,000 of mortgage debt. If you bought a home prior to December 15th of 2017, you're allowed the interest on up to $1 million of acquisition debt. So there's a little bit of a difference depending on when you bought that home, primary or secondary home, okay? Interest is going to be limited. It always has been, it probably always will be, and it really all comes down to when you bought the home, and number one, and number two, how much first position debt you have on that property. And it's not $750 per or overall for two properties, it's $750,000 of debt per property. So interest deducted on your primary up to $750 if it was purchased after December 15th of 2017, and the interest on up to $750,000 for a second home also purchased after that date. If you bought it before that date, you're grandfathered into the old revenue code. So do not worry about that, okay? So mortgage interest does have a limitation. On the property tax side of things, there is a much greater limitation. It's not per property, or it's not like the mortgage where it's $750 per property. On your property tax write-off, which what we call in the tax industry your SALT deduction, state and local tax write-off, you're capped at $10,000 total. And that's $10,000 for both properties, okay? It's not $10,000 per property, it's $10,000 for both properties. Now remember, we haven't talked about rental investments yet. We're only talking about the primary and the second home. So it's $10,000 total. A lot of taxpayers didn't know this, but under the old tax bill, this limit of $10,000, it's not new. It's just more defined under the new Internal Revenue Code. See, prior to 2018's reform bill, there was something built into the old Internal Revenue Code called AMT. AMT stands for Alternative Minimum Tax. And alternative minimum tax was already a cap or a lid on your SALT deduction, your state and local tax deduction. So as you filed your return, shoot, AMT is as old as the mid-'80s. So over the past 25, 30 years, every year that you filed, if you were subject to AMT, you started phasing out from being allowed the state and local tax deduction. So some of you in tonight's webinar, listening to this webinar, some of you under the old Internal Revenue Code might not have been allowed any of your property tax deductions, depending on how heavily alternative minimum tax impacted your tax return. AMT under the old tax bill kicked in at roughly about 140 to 150,000, and it fully set in on your return north of about 300 to 350,000. So there was a phase in and a phase out, essentially, or I'm sorry, a phase out and a phase in at that point. So if you were making $400,000 or $500,000 a year under the old Internal Revenue Code, fully subject to alternative minimum tax, there was a good chance that you've never been allowed your state and local tax deduction. So even though you saw your $20,000, $30,000, $40,000, $50,000 SALT deduction on your return, it was actually a number on your tax return. You might not have been allowed any of it as a tax write-off. And that, to me, is almost criminal, right? I can't really call the Internal Revenue Code criminal. It's more criminal to fight, to break the Internal Revenue Code. But from the opposite side of the spectrum, when we're looking at the Internal Revenue Code, to build something like that into the Internal Revenue Code that is so complicated that the general taxpayer doesn't even know what to do with AMT. They don't even know about it. They think it's like a venereal disease or something. AMT, I think I had that my sophomore year in college. No. That's a joke, by the way. Hopefully it didn't offend anybody. But no, AMT is not an STD or anything. AMT is a part of the Internal Revenue Code that disallowed your state and local tax deduction. That's how crazy alternative minimum tax was. Now, fast forward to 2018. If AMT under the old tax bill impacted you between roughly 140,000 and 300,000, fully set in at about 300,000, the IRS said in 2018, they took a look at AMT and they said, listen, AMT has not adjusted since the mid-'80s. A lot's happened in the US economy since the mid-'80s, so we're gonna lift the threshold for AMT all the way up to $700,000+, meaning that you and your household, either single or married, filing joint, you can make up to $700,000 now and not be subject to alternative minimum tax. As soon as you breach 700 to 750K, yes, then you become subject to alternative minimum tax. Okay, so that means now that under the new tax bill, you might not be subject to alternative minimum tax, so you actually might be allowed your SALT deduction, but the maximum write-off you get is $10,000. So some of you under the new Internal Revenue Code may actually be gaining a $10,000 deduction because you are not subject to this AMT anymore. Now, why the heck did I just spend 10 minutes explaining to you one of the most complicated parts of the Internal Revenue Code? Well, I wanted you to understand, one, how complicated the Internal Revenue Code is. Number two, why you should hire somebody if you're a higher income earner to do your taxes. And three, how unfair it is for the government to implement certain limitations that are so complicated for you to understand that you just don't even know if you've been allowed a deduction in the past or not. It's absolutely insane to approach tax filing without knowing angles or adjustments that you can make around certain limitations. And I can tell you right now that those limitations are pretty heavy on the primary residence and the second home side. The beauty of rental property is that rental income, rental property investments, they're not subject to any of those limits. Rental investment deductions are not subject to AMT. You could be making $1 million a year and your property taxes and your mortgage interest, if they're on a rental investment, have no limit. That's the beauty of having a business. And so if you have $1 million mortgage on a rental property, interest is fully tax deductible. You have a $50 million mortgage on a commercial property, interest is fully tax deductible. Property taxes of $100,000 on a rental investment, fully tax deductible, not capped at $10,000. So once again, the government allows rental property investors and business owners a majority of the Internal Revenue Code benefit. These are the true benefactors of the Internal Revenue Code, both old and new, and future. Even though we've heard a lot about what Biden might change under the Internal Revenue Code, I guarantee you that he is not the president who is going to change the real estate professional benefits for deductions that have been around since the early 60s, okay? And remember that when people talk about the 1%ers of the world paying less tax, one, it's because the 1%ers, the most common investment at high income levels is real estate, number one. Number two, these wealthy individuals, they've made all of their money probably through real estate and taking advantage of tax codes that have been around since the early 60s. Real estate professional statuses and benefits, basically claiming yourself as a real estate investor, a non-passive investor, meaning you actively participate, has been around since the early 60s, right? So real estate professionals have been taking advantage of this for a long time. I doubt that anyone will change that. Now, we could talk about the 1031 exchange. Like Will had mentioned, I don't think 1031 exchanges are going anywhere, to be real honest with you. I would probably be willing to bet on that as well, like actually put money on the line that 1031 exchanges are not going away. But like very much like AMT, the government loves to phase things in and phase things out based on how much household income you have. So sure, somebody making $20 million a year might not be able to exchange their properties anymore, but for lower income and middle income households, and middle income here in California can range up to like $200,000. Elsewhere in the US, not so much. But I doubt that it will go away for those individuals. So it may not go away fully. It may just be limited based on your overall adjusted gross income. That's what the IRS loves to do, is phase in and phase out certain benefits. So once again, rental investments, huge power moves for deductions and tax shelters, whereas the primary residence and the second home, they are seeing significant limitations on those deductions. Will, did you have a question?
Yeah, I just wanted to follow up because I know there was a question on Meetup specifically about how do you qualify as a real estate professional? Like, at what point do you qualify as a real estate professional? I get this question a lot from people who own rental properties, right? They're like, at what point, like, how many hours do I need to work, or what do I need to show so that I can qualify for some of these real estate professional deductions?
Sure, I did not forget about that question, and I just didn't know if that was the right time or if I'd wait till the end, but this is a perfect time to talk about that. The hour limitation for real estate professionals is actually something that, if ever audited, the real estate professional status is a highly audited part of an individual return, because it's not everyone who is allowed to check that box in the software program. Literally, there's a box in our tax software that when you check it, it tags you as a real estate professional. So a couple things need to happen. One, you actually need to actively participate in the real estate industry, meaning that 51% or more of your time has to be spent in real estate business, either selling property for commission income, managing your own investments, flipping property, just being involved 51% or more of your time, and 51% or more of your revenue, not your spouse's revenue, but 51% or more of your revenue has to be real estate related income. On top of that, and if you meet those two requirements, the hours probably won't be a difficult thing to prove, but the government can ask for an hour log. And you have to be ready to prove that you spend 750 hours or more working in the real estate industry. Now, I can add up easily 750 hours of real estate professional webinars that I've done in 1 year. So I know that if you actively participate in real estate, you'll hit that hour requirement, no problem. But in an audit, the government has the opportunity to ask for that hour log, meaning, you have to document emails, time spent in your real estate office, time meeting with clients and listing appointments, phone time talking. I mean, it gets a little ridiculous sometimes, but this is not something that you should navigate on your own. If you are ever audited, if your real estate professional election is ever audited, you need to work with a tax firm to represent you in front of the Internal Revenue Service. Do not try to approach that audit representing yourself. The IRS will walk all over you, guaranteed, because they know that you do not know Internal Revenue Code like we do. That's why we have what I call the bat phone. We call the IRS on a tax practitioner priority line. You call the normal 800 number, which you could wait 3-4 hours to talk to the IRS. Our wait time is about 1 hour to 2 hours right now on average. Normally, if the IRS was fully staffed, it only takes about 20 minutes to get a hold of them. That's why they want to talk to us about tax code, because we know kind of the angles and the positions and the laws behind the Internal Revenue Code. So once again, the election is about hours, 750 more hours worked in the year, but then the 51 rule also has to apply. See, if you're a brain surgeon making $3 million a year, even if you only worked 3 months out of the year, and once again, 9 months was taken off and you invested in real estate, because you're making $3 million a year through brain surgery, K1 or W2 income, they're going to hit you with the 51 rule, not the 750 hours, not the 51% or more of your time spent in real estate. They're going to look at your revenue. They're going to say, well, that's great. You save people's lives and you fix people's brains. But at the end of the day, 51% or more of your revenue is generated from medical professional income, not real estate income. So once again, this conversation should not be something that you have with yourself and filing on your own. You should have these questions and these conversations with ready and with a licensed tax advisor. So 750 hours if you're looking for that number, but there's a little bit more involved in all of that. Okay. Now, retirement planning, as we approach the end of the year, a lot of people will have questions about whether or not an IRA or a Roth IRA or a solo 401k or a solo Roth 401k or a traditional 401k would be right for them. There are many different retirement accounts. In fact, up until 1974, there was only really one type of retirement account and only one type of investment you could have under your retirement account, and that was stock trading. I mean, up until 1974, most people just plugged their retirement into the stock market And at that point, I'm a stock investor, so I'm not bad mouthing stock investing, but it is legally gambling your money, right? I mean, one tweet could cause a 600, 700 point drop in the Dow. I mean, that's how fragile the stock market is these days. So I like diversified investments. I like diversifying my retirement accounts. And so starting in 1974, the federal government said, no longer do you have to invest all of your retirement in the stock market. You can actually take a portion of your retirement and buy real estate with it. You can take part of your retirement and invest in real estate syndications with your IRA. You can buy businesses under your IRA. You can even do hard money lending out of your IRA or your 401k. Now, it can't be a traditional IRA or a regular 401k doing this. It has to be rolled into what's called a self-directed IRA or a solo 401k. And these are self-directed retirement plans, meaning that you can have a portion of it invested in the stock market, and then you can have the rest of it plugged into real estate. Something, practice what you preach. If you're a real estate person and you talk and explain real estate over the Thanksgiving, dinner table, and you work in a real estate office, practice what you preach, right? Invest in real estate in your actual life and realize gain investments, but then also have a portion of your retirement plugged in to consistent long-term dividend paying investments, such as rental real estate investments. And the greatest thing about a retirement plan is that all of the gains that you make within that 401k or that IRA are tax deferred. Every dollar you make avoids paying tax until you retire, right? And so a lot of people will say, well, I want to defer the tax because I'm in a higher income bracket. So if I'm in the 35% bracket, I'm going to put as much money into my retirement to avoid that 35% tax rate on all of this gain, right? Some of you might want the Roth module. And remember that Roth retirement investments are great. You pay the tax up front and the growth is tax-free. So when you retire, you can access all of that gain tax-free out of the Roth. So depending on which retirement vehicle is best for you, that's something that you need to determine alongside a financial advisor or a wealth manager, as well as your tax advisor. If you're looking for the benefits of both worlds, you could have a little bit of both. Or even if you're in a higher income bracket and you don't qualify for a direct Roth IRA investment, you can do something called a backdoor Roth conversion, where you contribute to a traditional IRA account, but then immediately convert it into a Roth account. You're not getting any tax benefit for that because you're actually converting it into something where you pay the tax up front. But now in a higher income bracket, you've been able to park your money in something that will grow tax-free. So imagine if you have an insider information, not on stock tips, but insider information on a pocket listing, and you go into that investment with your IRA and you convert it to a Roth IRA. Now, all of a sudden, all of the cash flow from your rental properties, all of the appreciation and gain, if you ever sell that property, you pay zero tax on it because it is all owned under your IRA, right? That's if it's traditional. If you sell it, once again, all of that gain, because the initial deposit on the property was you already paid tax on it, all of that appreciation under a Roth would pay no tax. So once again, it might get a little confusing when we talk about both. That's why this conversation needs to be had with a licensed tax advisor. And we can map out both roads for you. That's one of the benefits of having a service like a tax advisor, because we can map out which one makes more sense for you at any given time throughout your financial career. Sometimes when you're just entering into real estate, a Roth makes more sense. Sometimes as your bracket starts to inch up into the 28, 32, 35% brackets, you may want the actual tax-deferred retirement investment. Sometimes because you have enough cash flow, you have enough in savings, you don't mind paying the actual tax on it when you do the Roth conversion. So it really all depends based on your own financial situation, your own financial world, which one would be best overall for you. And it's not just a tax advisor, it's a wealth manager, tax advisor, a real estate professional that gets involved in all of this. So just be aware that there are options that you have. You just don't have to throw your 401k into the stock market and watch it go up and down and play this whole roller coaster game like we've seen over the past, couple months. The Dow hit all-time record highs, but once again, today was a perfect example. We had an all-time high and then all of a sudden it dipped today, and certain stocks are making money, others are not. And it really all comes down to news about the stimulus package, comes down to tweets from our president, comes down to news about the COVID vaccine. It could be a number of things that impact that retirement plan of yours. So just be aware that you have options, okay? I'll stop talking about that for a second. Now, as you invest your money in real estate investments outside of a retirement account, you may be thinking to yourself, is an LLC right for me? Or should I put it into some other type of entity, or should I put it in a trust? Well, I'm not going to spend too much time on this because I feel like I sometimes get ahead of myself. And this is a whole 1 hour to 2 hour webinar just in itself, entity selection. So I can always come back and do another webinar on the power of Inc. But I want you to take this away from this slide. LLCs are great and only beneficial from a legal standpoint. LLCs provide absolutely no tax benefit for you. And so therefore, LLCs are best for holding long-term depreciating assets under, like rental investments. Because if they're not going to save you any tax, they're best for protecting large assets. So rental properties in LLCs. And the reason, another tax reason why you don't want to put rental properties in other types of entities is because rental properties only pay federal and state income tax. They don't have to contribute to Social Security, Medicare, state disability, unemployment insurance. So because they pay the bare minimum federal and state income tax, they deserve the great asset protection of a limited liability company. And they don't need any of the other tax savings entities because all they pay is federal and state income tax. Now, if you are that property flipper, property dealer, real estate professional making commission income selling your properties, you pay federal and state tax, but then you also have to pay self-employment tax at the end of the year. So you have to be understanding that rental properties don't pay as much tax as you do as a self-employed individual. So an LLC might be great for limiting liability on your business, but when you get ready to file your tax return, a tax advisor is going to flip your LLC realtor business into an S corporation. Because the S corporation, it won't help you reduce federal and state income tax, but what it will cut by upwards of 60% is that nasty self-employment tax that you have to pay on all of your profit from your commission earnings from selling real estate. Now, the way that you utilize an S corporation to your benefit is by actually putting yourself on payroll. So as a sole proprietor or an LLC, you don't have payroll. Everything is basically taxed on the full profit. You pay federal, state, and self-employment tax. In this case, in this example, on the full $100,000 profit. But as an S corporation, real estate professional, on $100,000, you pay federal and state income tax on the full 100K, but you only pay self-employment tax on what's considered to be a reasonable salary, which you have to put yourself on salary. You're not self-employed anymore. You're actually an employee of a corporation that you own. And employees receive W-2s. And you don't have to pay yourself any more or any less than 40% of your company's net profit. Well, 40% of 100K is 40,000, and then you get to write yourself off. You actually get to deduct your salary from your profit, and that leaves your company with a leftover profit of $60,000. Now, what you've just achieved through all of this madness is you've allowed yourself to minimize self-employment tax, now called payroll tax, to only $40,000 of your profit. And on $60,000 of leftover profit, you have avoided completely on the $60,000, 15.3% of Social Security and Medicare tax. That equates to about $9,180 in overall tax savings because you are avoiding paying Social Security and Medicare tax on $60,000. Now, some of you might be thinking, well, 100K, I'm not even close to that. This wouldn't matter for me. Well, cut it in half. Drop it down to $50,000 in net revenue, and the calculation still makes sense because the calculation that we need to map out for your clients, for our clients, is to figure, is it going to cost you more than it's saving you? Or is it going to save you more than it's costing you? Of course, we get great asset protection by incorporating, but we need to make sure that financially it makes sense. And at about $40,000 to $45,000 in net profit, that's where you get closer to almost a break even, where it saves you as much as it costs you. But at $50,000 of income, it still saves you about $2,000 more than what it's costing you to file every year as an S corporation. So once again, we need to map all of this out for you. I'm being very general because I don't know all of your individual tax situations or your tax return information. And that's why we offer this free consultation, which once again, I'll get to that in a second. But we need to sit down and map out this plan for you to make this calculation for you to make sure that if we advise you to incorporate, that is the correct advice for you. It's not going to be right for everyone. Incorporating is not right for everyone. I want you to take that away from this slide, that I'm not sending you out back into the wild to incorporate. I'm telling you that this may be a benefit for you in your situation, depending on if the numbers make sense. Okay, so just be aware of that. S corporations for self-employed businesses, LLCs for rental investments. LLCs should not be put in S corporations because rental income is not self-employed income. Only self-employed income businesses should be put into S corporations, okay? Because once again, they get the benefit of self-employed tax reduction. So once again, that's a whole webinar just in itself. If you have more questions about that, we'd be more than happy to answer those in a more one-on-one, situation. through our free consultations. Now, part of this pandemic, kind of the aftermath of, well, not even the aftermath, we're still in the middle of it, but part of the results or the effects of the IRS layoffs due to COVID-19 and the pandemic since February, the IRS laid off thousands and thousands of employees. So it has caused longer processing times, erroneous letters, incorrect assessments, lender-borrower complications, delays on the preparation side. I mean, you name it, it's been a problem this year. And so I have adopted a characteristic that I've always known that I've had somewhere deep down inside with the IRS, but this characteristic is patience. I found myself more often than not this year talking with agents on the phone, trying to get them to move quicker than they actually are physically able to. I'm not saying that they're not able to get out of their chair. It's just some things are completely out of their control. And so right now, just to give you kind of a backdrop of what's happening at the government level, the IRS is about 3 million documents behind in processing and about 1 million tax returns behind in processing. That equates to about 8 to 10 months in delays on the government side. They're trying to catch up, but you've seen the spike in COVID cases, so they haven't really rehired all of the individuals that they've laid off. So be patient with not only a tax advisor, we're working for you, we don't work for the government. So when we call the IRS and we tell you that, hey, the IRS still hasn't processed something, unfortunately, and I have to ask this of you, you just have to believe your professional. You have to believe your tax advisors. We are in contact with the IRS every week. And I'm sure that they're tired of us calling. We get a different agent every time we call in because they have hundreds of thousands of employees. But when they laid off as many employees as they did this year, it really caused backup in their pipeline. And they're really trying to flush that sludge out of that pipeline as quickly as possible. But it is causing their computer systems to preemptively send out correspondence letters stating that clients will owe money that they don't, and then we have to get on the phone and write abatement letters. I mean, there's been a number of those situations this year. So just be patient with everything. Don't freak out if you get correspondence from the IRS this year. There have been more correspondence letters sent out this year than ever before because of that extension of the deadline from April 15th to 7/15. The computer systems at the government level weren't updated by July 15th. So naturally, everybody looked like they were filing late. Can you imagine that? I mean, it's insane. It's absolutely insane. But just understand that you're not alone. If you have fallen into this kind of category where you've gotten things from the IRS, you are absolutely not alone, but you should not be handling the correspondence. Your tax advisor should be handling all of the correspondence with the IRS, just to be aware of that. Now, I told you about this free consultation. We do offer 30 minutes in person normally, but now it's over the phone, via FaceTime, via Skype. We'll review 2 years of tax returns for you. We'll check for possible audit triggers on your individual returns and your business returns. And if anything needs to be corrected, we'll go ahead and amend the return. I have no qualms in correcting errors on tax returns and amending those returns to make sure that we get the additional refund, or in some cases, if something was missed, if an additional income source, let's say you pulled money out of a retirement account, yes, it might not be fully taxable, but a portion of it may be. So once again, we have to adjust those numbers. And so sometimes you might have to end up paying a little bit more, but it's much better to catch it right now than it is 2 years down the line when the government gets past their 8 to 10 month delayed processing times and actually catches up with that and tries to charge you penalties and interest over a 2-year period. Insane, right? And we'll also put you on a free periodic tax email update, letting you know about upcoming webinars that we're having. All of our education is free, by the way, here at Robert Hall. And I feel like, once again, I'm very privileged here at Robert Hall & Associates to be able to bring all of this information to you. As the year progresses in 2021, as we know more about Biden's tax position, we'll put together webinars solely based on 2021's tax code. I can tell you right now, my personal belief is that because inauguration is until January 20th of 2021, I doubt that Biden's tax plan will have very much impact on 2021. I think that we'll probably be looking more at the impact in 2022 than in 2021, to be completely transparent about that. It takes a lot longer than people think for Biden or any president to implement changes to the Internal Revenue Code. There's a lot more than just writing some notes on a napkin and passing it into IRC, right? I mean, this has to pass legislation. The House, the Senate have to agree on it. Congress can veto certain. I mean, there's a number of roadblocks that could run into. So, and I think that will play in our favor, especially if the 1031 exchange actually is on the chopping block. I don't think it will go anywhere, but what we may see is clients phasing into the benefit and clients phasing out of the benefit. All right. So we may see a little bit of adjustment on that end, but I do not think that will happen for 2021. A lot of the current tax code is set to sunset in 2023 anyway. And I don't know if Biden's administration is really all about reversing everything under the 2018 tax bill. I know that they want to change a couple things with, Medicare and the health insurance, requirement and whatnot. But once again, we just don't know any of that. That's all speculation at the moment. Nothing is set in stone. So all we can do is plan for 2020 and assume that in 2021, things will be very consistent with 2020 because we're 22 days away from the end of 2020. The government has never been able to push through a tax bill quickly enough to only give us a month in 2021 or 2020 to plan for that particular change. So just be aware that there might be a little bit more consistency in 2021 than the general public feels, from information that the news media outlets are giving us, right? You have to take all of that with a grain of salt. In fact, most of the time, news media stations, they hire people who aren't even tax professionals to give you tax advice. I think that should be more illegal than anything else. In order to give somebody advice on something as important as taxes, I think that the person giving you advice should be licensed, that has over 1,000 hours of education every single year, that has been working in the tax industry for more than a decade, right? I mean, you want those kind of professionals giving you advice. And unfortunately, the news outlets, they don't care. They don't care. They just want to bring you information, scare the general public, and cause all of this havoc. But immediately, if you hear something that doesn't sound correct, you know what? Pick up the phone. Call us. Call Robert Hall and Associates. Get that free consultation because we'll get you the correct answers. So I just want, once again, being very transparent about all of that. In order to sign up for a free consultation, easiest way is open up your web browser. Go to roberthalltaxes.com/consult. Type in your information. We'll get you on the calendar as soon as possible. I know we only have 22, 23 days left in the calendar year. There's still plenty of time to plan, okay? Plenty of time to plan. And if you feel like, man, this year end really creeped up on you, yeah, we still have time to plan for 2020. Don't feel like, too bad, so sad that you're up a creek without paddles. Sign up for this free consultation. Let's get you on the calendar as quickly as possible. Will, I know that we have a couple other questions. I don't know if I answered those throughout.
Yeah, let's jump into some of these. Sean asks, do you know if in the inheritance property tax on non-owner occupied in Prop 19 that just passed is avoidable in any way, such as a different type of trust, a family trust? I've heard different things. Thanks. Anthony, I know you are very involved in Prop 19, so if you're still around, maybe you can jump in as well, but do either of you know anything about this? Oh, Anthony, you're muted.
Sorry, I haven't heard of any way to avoid that yet. But yeah, through trusts and things, there's a lot of taxes are different, right? So I don't know, Tony, have you thought about that yet?
So just as a heads up to everyone, property taxes and income tax, they are two completely different worlds. I know a lot about Prop 19, but I want to mention that what I've done yesterday, I did 3 webinars. Today, I've already done 2 webinars. I have one tonight after I hop off this one. And this is a consistent question in a lot of the webinars right now. And I do want to mention that I can't give you, general answers to Prop 19. I really need to talk with people one-on-one to map out a plan for you each individually. But I can tell you right now that the most consistent question or comment on Prop 19 is, should I start transferring assets to my heirs before this passes? Now, understand that once again, that property taxes and income tax, 2 completely different worlds. If you have sizable investments, if you have investment property that's worth millions and millions of dollars, understand that Prop 19 might sound like a terrible thing, and it is for the most part if you do have to pay that increased property tax bill. But you know what's even worse? Is giving up the #1 benefit built into the Internal Revenue Code, both old and new, which is something called the stepped up basis benefit as part of the inheritance tax code. Meaning that if you transfer a property, let me give you an example. Let's spell it out in numbers. Let's say that I bought a property 50 years ago for $100,000. Now, 100,000 50 years ago, that's a lot of money, right? So now that property, let's say that it's $3 million. And over the course of the 50 years, I've been able to tap into equity, buy more real estate. And now all of a sudden, my real estate portfolio over 50 years is now $10 million, right? Value of property shooting through the roof. I have a ton of cash flowing investments. I have no debt on the property. I'm sitting pretty. And now Prop 19 passes and I'm freaking out because if I leave or my children are now freaking out, not me, my children are freaking out because once they inherit that property, then they have to pay the increased property tax base.
Well, understand that if I transfer those assets to my children, they inherit my basis in the properties. And what was my basis on all of these properties? Let's call it, I don't know, $300,000. I mean, but that's way low. Let's call it $1 million. $1 million in basis on now $10 million in assets. If I transfer those assets to my children to avoid Prop 19, sure, I might avoid the stepped up property tax issue, but what I've given up is $9 million of tax-free appreciation, because the stepped up basis ruling under the current Internal Revenue Code says that if I leave those properties for my children in death, they inherit all of those properties up to $12 million in assets tax-free. Meaning that all of the depreciation I've taken on the investment properties, all of the appreciation that I've seen over the past 50 years, all of that benefit, guess what? I pass on the tax to them. That is a much greater tax liability than them paying more in property taxes on a property that they're basically getting for free, right? So I'm not saying, once again, I'm not trying to play devil's advocate here. I think Prop 19 is terrible personally, but at the end of the day, is there a significant change once you start transferring assets over to your children? Well, yeah, because you're giving up that capital gain tax-free exclusion just to save face on the Prop 19 adjustment. So once again, I can't really give you a definitive answer in a webinar. I need to talk to you individually. At RHA, we need to talk to you individually about your specific scenario to map out a plan for you. I'm not saying that there are ways to avoid it. I'm not saying that there aren't ways to avoid it. I'm saying that we need to talk to you individually about your specific scenario. And so I'd highly suggest that you really push you to that free consultation, if anything.
Tony, there is talk, once again, this was in the Biden plan, that they would that he was going to propose to get rid of the step-up basis.
Once again, a lot of it's speculation.
Right.
I don't think that he heard cheers behind that particular change. I know that there's a lot of people out there who want that to go away, who think that there should be a significant wealth transfer from the wealthy, the 1%ers, to middle income and lower income households. But once again, a lot of this has to pass multiple barriers before it gets passed, right?
Great.
And I think that there will be a lot of grandfathering into certain things. Once again, the government doesn't like to get rid of things altogether. They like to phase things in and phase things out. Sure, do I think Jeff Bezos should be allowed this benefit? No. He's going to have a state tax through the roof anyway. He's a billionaire. He could pay taxes 1,000 lifetimes over on some of the wealthiest people here in California and still see billions of dollars in his bank account. So yes, there might be an adjustment for those types of wealthy individuals. But once again, we've really got to sit down and not make rash decisions before we know definitively what is going to be passed in Biden's tax plan. But we'll be readily available with that information. We're going to be the first ones to know about it. We have our ears to the ground, and we're always researching and taking courses and talking to revenue agents about these changes. So we'll be able to put together a webinar as soon as we know some answers for you.
Absolutely. James writes, I am an existing Robert Hall and Associates client. I was able to complete my taxes last year prior to the first lockdown in March. What is my appointment with my accountant going to look like this year? I doubt it will be face-to-face. My appointment is at the end of February. Being a Robert Hall client myself, I can answer this question because I actually did my taxes, actually split the pandemic. I did my first one in person and then the second one after the lockdown. And I can tell you that it will not be in person. It will be via Zoom or Skype or another way. Tony, I'm sure you can elaborate, but I'm just letting you.
Yeah, unfortunately, we're just not able to. I mean, when pre-pandemic, we would see 120 people in our office per day. I mean, that's the kind of volume that our firm does. We would literally have 120 warm bodies in our office on every day, Monday through Saturday, for 3.5 to 4 months straight. So it's just not, I'm not going to say it's worth it. We've really spent a lot of time, a lot of money, a lot of focus on developing a system here at Robert Hall that would allow us to be just as efficient digitally as we were with the in-person appointments. And so unfortunately, until the pandemic really starts to settle down, until LA starts to release a little bit of their restrictions, the shutdown, we're going to have to stay close to the general public. But once again, we all have the ability to connect with Zoom, with FaceTime. A lot of our clients were dropping things off at our office. We do require the appointment information to be dropped off 2 days prior to the appointment because it has to sit in its own quarantine room for about 24 to 48 hours before we actually pull those files and have people touching them. It is an incredible struggle. And I don't use the word hate very much, but I hate the position that we're all in. But the number one goal is to keep people safe, to keep our staff safe. They have family, they have parents who have underlying health conditions. And so as a firm that employs 50 plus people, we have to abide by CDC guidelines. And if it was only 10 people we saw each day, yeah, I think we could make it work with the dividers and everything. But pushing 120 people out of our office, not staff members, these are 120 clients coming into our office every day. We just have to abide by more of those rules. So unfortunately, it's probably going to be not in person, but digitally. Now, if you file an extension and take it out to, August or September of next year, very much so could we be back to status quo, meeting in person. We just don't know yet. There's a lot of uncertainty ahead of us in the upcoming months. So we'll open our doors as soon as we can, though I can tell you that right now. All of us don't like doing things digitally. I mean, it's great that we're able to keep up our business practice, but I'd much rather sit in person with clients than do it digitally. It becomes a very lonely industry to work in, to be real honest with you, when we can't meet with our clients face to face. So I personally cannot wait till we're back to whatever the new norm is going to be.
Absolutely. And the last one is just a comment from one of my favorite people, Alan Gecht, who's a fantastic commercial agent focusing on office. He just wrote just a comment. Tony is doing an excellent job. So
thanks, Al. Really appreciate it. I know it's a lot of information crammed into a small presentation, but I'm appreciative of that comment. Thank you. And I'll be bringing you more up-to-date information as the months go by. So,
yeah. So, thank you, Tony. Thank you for your time. Thank you for your for your information. Yes, Anthony, do you want to talk about our event tomorrow?
Yeah, I would just love to invite anyone who's on. We could all use a great laugh right now. So I've hired 3 comedians. We're putting on a free comedy show for anyone who'd like to tune in. It's tomorrow at 8 o'clock. I posted the link in the chat. It's comedy@thecollective.com. And if you'd like to make a donation, the money that we're raising is to help LGBT homeless youth that are out on the streets in LA right now. Most of the youth that's homeless is LGBT. So we're raising money for them, but the show is free. So we'd love for you to join us tomorrow at 8. Have a good laugh. It starts at 8. It'll probably be just about an hour show. Again, the link is comedy@thecollective.com. So, I mean, appreciate all of you guys for being part of our family this year. We have a lot of great sessions coming up for next year. So hopefully you'll stay tuned, spread the word. If you're not on our meetup page, that's the best way to follow us and get all the updates. It's lamultifamilymeetup.com, as well as all of the classes we've done this year and webinars are on our YouTube page. So the benefit of being virtual this year is that we've been able to record everything, and it's all that info is there for you. So you can check out The Collective Realty on YouTube and go through all of those great webinars. Will, you've done an amazing job putting together a great schedule for us this year, and I'm looking forward to next year. Tony, thank you so much for everything you did today. You're always a great speaker. And I just, look forward to growing with everyone and continuing to help everyone build wealth in 2021.
Love it.
Thanks, everybody.
All right, take care, everyone.